I hear people ask me these questions a lot. Hey Grayson, I just buy the stocks of ABC company last week. Why I still don't earn any profit right now? Hey, I want to ask you, are you investing or are you gambling? Because investing and gambling is two different concepts. Gambling is you see or hear someone saying that some stocks is doing really good. You hear everyone is saying, is discussing about the stocks. They say they have earned how many profits, how many percent profits there, and you got the fear of missing out and you buy in the stocks. And what usually happens is you buy in at a very high price, and when it dropped you got panic and you sell out and you got a loss there and you lost your money. That's what happened when people is gambling in the stocks market. In investing, you have to do your proper research, you have to do the analysis, and then you have to check the background of the business and then you buy in the stocks. So gambling and investing is two absolute different concepts. So today I'm gonna tell you the 6 simple steps on how to start your investment journey. So let's get to it. Hey everyone, it's Grayson here. Welcome back to my channel. So today I'm gonna give you the 6 simple steps on how do you start your investments. So the first step is very simple, is you have to find out your own risk tolerance level in the financial market. It means how much risk you can take or how much pressure you can take from the financial market itself. For example, if you're a high risk taker like me, you can invest in higher risk investments like stocks market, mutual fund, hedge funds, unit trust, etc. But if you are a low risk taker, like you cannot take any risk in the stocks market, and you are always panicking about your money, you are always worrying about your money, you think about your investment 24/7, then you can only invest in lower risk investments like bonds, commodities, gold, silver, fixed deposit, centralized deposit, or even savings account. Because I want you to sleep very well at night, I don't want you to always worry about your investments. But you always have to remember, the lower risk you take in the financial market, you can only get a potentially very low returns or profits from your investments. And vice versa, if you invest in higher risk investments, and you can expect a potentially higher returns from your investments. So it really depends on what do you want. You have to find out the balance point between how much profit you want to get and how much risk appetite you can get, or how much risk appetite you can take from the financial market. So moving on, the second step is to find out where do we want to invest in. It means which industry or even which country do we want to invest in. Because buying a stock is like buying a part of a business itself. So you really have to understand what's the business model behind the stocks. For example, like myself, I don't know anything about oil and gas industry. So I won't go to buy a oil and gas stocks just because someone says it's good or someone says the stock is doing very well and I get fear of missing out and I buy the stocks and I hope it will go up. No, it doesn't work that way. We have to really understand the business, what's their biggest revenue, what's their biggest expenses, and then we will consider to buy in the stocks. Same with the countries. For example, if I want to invest in Indonesia, for example, I have to consider their political risk, their domestic risk, their natural disaster, etc. So the second step is very simple in conclusion, is to find out where do we want to invest in, which industry, which country, and how much do we want to invest in it. Oh, by the way, before you invest in any investments, make sure you have at least 3 to 6 months emergency fund cash set aside just in case your investments goes wrong and you still have the financial support to yourself. Because you don't want, just because of one bad investment decision you make, and it will affect your life in reality. And that's why it's very important you to have extra cash set aside at least 3 to 6 months before you invest in any investments.
And step number 3, and this is probably the most important one among these 6 steps, is to have the enough knowledge and the proper and right educations for what you are about to invest in. Well, you know how always people say investing is very risky and it's very dangerous. Well, it's not 100% wrong, because you see, in the world of investing, things can go wrong very easily and very quickly. So the best way to prevent it is to prepare it. If you have the enough preparations, if you have the enough knowledge and educations for what to do when things goes wrong, then we wouldn't get panic. You have to know this. The traditional educations like high school, college, or even university, they won't teach us anything about real life investings. So the best way to learn about investing practically is to read books. Read a lot of books that related to investments and finance. Some of the books that I recommend are Rich Dad Poor Dad by Robert Kiyosaki, Intelligence Investor by Benjamin Graham, etc. You can read a lot through books, through articles, online, ebook, or even you can go to some courses, or even you can read some of the financials and investments related article in Yahoo Finance, in Bloomberg, etc. There's tons of way to learn things through online and even some for free nowadays in the world of technology. So it really depends on how much will do you have to learn and to have the enough and proper educations and knowledge from the financial market. The more you learn, the more you will excel.
So you got everything ready, you got everything prepared, so now you want to get started with your investments. So let's go on to step number 4, which is choose and only invest with trusted and regulated broker. Because in the end of the day, we don't want people to take our money and just run away, right? That's why it's very important to trust our money into the good hands and the regulated side. For example, there's many trusted investments broker in Malaysia. For example, like Maybank, Hong Leong, Public, CIMB, etc. They all offer brokerage service which is very regulated and trusted. Many people are using it, and we can trust them because they are regulated by the Bank Negara, which is the central bank of Malaysia. So we don't want to put our money into risky hand, for example like some third party broker which guarantee us something, some benefits, and we don't take those for granted. We always stick to the regulated and trusted investment brokers only. And for those that don't know what a stockbroker is, the stockbroker is the person, is the middleman between you and the stocks you want to buy. Because you cannot just go to the company and say, hey, I want to buy your shares. You have to go through the stockbroker. That's why stockbroker is very important. It's a middleman between you and the stocks you want to buy. And step number 5 is to come out with your own investment strategy. So what is investment strategy? It sounds very complicated, right? But trust me, it's not. The most common investment strategy that people are using, and including that I'm using, are they take out 20% of their monthly income to put into their investments. And how do you allocate the 20% is totally up to you. You can take 10% to put into unit trusts and another 10% to put into individual stocks. Or you can take 10% to put into unit trusts and 10% into lower risk investments, for example like bonds, for example like commodities, savings accounts, etc. But it's definitely up to you, and it's in the end of the day it's come back to how much risk tolerance you can take and how much profit you expect from your investments. But the most important thing is to stick with your investments plan, to stick with your investment strategy. Never let anything or anyone to affect your plan and to change your strategy. For example, if you plan to invest monthly, and you better stick with your plan and invest monthly. Never skip the routine, because once you skip, your plan is ruined and your investment strategy is ruined as well. So again, step number 5 is very important, to come out with your own investment strategy. Last but not least, we have step number 6, which is always stay committed in the financials market. It is very important to stay committed in your investments, because in your road to investments is not easy. And there will be always outside noise, or there will be outside factors to affect your judgment or affect your investment strategies. So you have to always stay committed and always stick to your plans, to your road to investments. Never let any outside factors or any outside voice to misjudge or to affect your initial plan or initial strategy. And before I end the video, I just want to remind you that it's very important to invest in the long term. It's like the old saying, never time the market. Instead, we give time to the market and let the market reward us with something called compounding interest. Always remember to invest in long term and never aim for short term gains, because what comes fast, go faster. So I hope you're having a good day ahead and always stay safe out there. See you in the next video. Take care.